So what if the next 10 years in the stock market looked, well, a lot like the 10 years after the dot-com bust? A wild ride of volatility, a couple of nasty crashes, and in the end, you get basically zero returns. It sounds pretty dramatic, I know, but some of the smartest investors on the planet are getting ready for that exact scenario. Let's dig in and see what's really going on. Just look at this number for a second. $340 billion. Now, that's not some country's GDP or a huge tech company's valuation. Nope, that's the record pile of cash being held by just one investment firm, Warren Buffett's Berkshire Hathaway. And that really brings us to the big mystery, doesn't it? Why is arguably the greatest investor of all time just sitting on a mountain of cash instead of putting it to work in the stock market? It kind of makes you think he's seeing something the rest of us might be missing. So let's play detective and see what he sees. Okay, so our investigation starts with the market's biggest warning signs. Think of these as the flashing red lights, the crucial clues that tell us something might be, well, a little off right now. Our first clue is something called the Shiller PE Ratio. Now, don't let the name scare you. It's actually pretty simple. It's just a way to measure if the stock market is cheap or expensive. It does this by comparing today's stock prices to their average earnings over the last decade. By looking at a whole 10 years of real earnings, it filters out all the short-term speculative noise and gives us a much more stable, long-term price tag for the market. So where does this ratio stand today? Well, the historical average is around 17. Right before the dot-com bubble burst back in 2000, it hit an all-time high of 44. And today, we're sitting at 39. That is incredibly high. In fact, it's the second highest it's ever been, right behind the peak of one of the biggest bubbles in history. Yikes. All right, clue number 2 comes from the man himself. It's literally called the Buffett Indicator, and this one's even simpler. It just compares the total value of all stocks in the market to the size of the entire U.S. economy, the GDP. You can think of it as a big picture reality check, anchoring the stock market to the real economy that's supporting it. And right now, that indicator is flashing bright red. It's sitting at over 200%. What does that mean? It means the stock market is valued at more than double the entire economic output of the country. This isn't just high. It's another historic record, and it's screaming significant overvaluation. So we've got these two major clues, both pointing to an extremely expensive market. But what does that actually mean for us? To really get a handle on the potential consequences, we need to look back at the last time things looked this spooky. We need to look at history's echo, the 2000s. And when you look, the parallels are, well, they're pretty striking. Back in 1999, right at the peak, the Shiller PE ratio was near its all-time high. The Buffett indicator was at a record high. Sound familiar? Because today, the Shiller PE is once again near its all-time high, and the Buffett indicator has set a new record high. The setup is just eerily similar. Which, of course, leads us to the million-dollar question. If the setup is the same, what on earth happened after that 1999 peak? What came next was a truly brutal, decade-long trip to absolutely nowhere for investors. The market peaked in 2000, then it crashed. It finally bottomed out in 2002, clawed its way back up, only to get hammered again by the 2008 financial crisis. It wasn't until 2012, 12 full years later, that the market finally and sustainably got back above its 2000 highs. That whole period is now known as the lost decade for stocks. Which brings us to the core idea of our whole investigation, connecting that painful past to our, let's face it, potentially perilous present. We might just be on the verge of the next lost decade. So here it is, the central thesis, based on all these historical parallels and these sky-high valuation metrics, is that the stock market could be entering another long, drawn-out period of stagnation, potentially delivering near 0% returns for the next 10 years. And that explains why an investor like Warren Buffett might prefer the simple safety of cash over a dangerously overpriced market. Now, if this scenario does play out, it doesn't mean you just give up on investing entirely. Of course not. It just means the old playbook, buy everything and watch it go up, might not work anymore. It's going to require a new strategy, a new playbook for a very different kind of environment. So what's in this lost decade playbook? Well, first, you might shift your focus away from those high-flying growth stocks, the ones that really rely on a rising market to do well. Second, you'd probably want to prioritize value stocks, solid, profitable companies that actually pay out dividends. And third, you'd consider the safety of things like short-term treasuries, which pay a guaranteed interest rate. This is pretty much exactly what Buffett is doing, hoarding cash in treasuries while he waits for good, valuable deals to show up again. And the logic here is really simple. If the whole market isn't going to rise, you can't rely on stock prices just going up to make money. Instead, this strategy is all about generating a steady income stream from dividends and interest payments. It's a defensive game plan for a market that's just moving sideways. And that brings us to our final and pretty powerful question. We've seen the warning signs. We've seen the historical parallels that are causing even legendary investors to hit pause. So we have to ask ourselves, is the market's past about to become its future?